global markets are showing a real mix right now.
Yeah, a mix of gains and some cautionary signs.
A lot to unpack for sure.
It is a time for investors to be very discerning. There are definitely opportunities out there.
But we need to understand what is happening.
Absolutely. Understanding the nuances of this current economic landscape is crucial.
So let's start with global stocks.
Okay.
We're seeing a major global equity index up, and the U.S. markets are looking fairly resilient.
Right.
But is this genuine strength?
Well, that's the big question, isn't it?
Yeah. Or are we just kicking the can down the road?
It's possible. The gains we are seeing are being driven by the big tech companies.
Especially in the U.S.?
Especially in the U.S., yeah.
Nvidia and Broadcom have been huge.
They've been the driving force behind the recent surge we've seen.
In the NASDAQ and S&P 500.
That's right.
But are they masking underlying weaknesses in the economy?
It's possible. Their performance has been impressive, but we need to look at the bigger picture.
Right.
We can't just rely on tech to prop up the whole market.
Especially if other economic indicators are flashing warning signs.
Exactly.
And one of those warning signs is U.S. consumer confidence.
Yeah.
The Consumer Confidence Index took a pretty unexpected dip this month.
That's definitely concerning. Consumer spending drives so much of our economic growth.
So when confidence wavers,
It can have a real domino effect on different sectors.
like people might think twice about those big holiday purchases.
Exactly. And that could impact retail stocks and the whole economy.
Yeah, for sure.
It's a development that we need to keep a close eye on.
Absolutely. Now, another interesting data point is durable goods orders.
Okay.
New orders for key U.S. manufactured capital goods actually increased in November.
Which seems to suggest that businesses are continuing to invest.
In machinery and equipment.
Right.
Right.
Which is usually a good sign.
Yeah, it points to some confidence in future business prospects.
But the overall picture for durable goods is a little more complicated.
Yeah, because the overall figure actually declined.
It did, and it was mainly because of a drop in commercial aircraft orders.
So it just goes to show that we need to look beyond those headlines.
Absolutely. We have to dig into the details.
Now, the bond market is also giving us some food for thought.
Oh, really? How so?
The 10-year Treasury yield jumped to its highest level since late May.
Interesting. What's driving that?
Well, a couple things. Rising Treasury yields can signal inflation worries.
Makes sense. Investors want higher returns to offset that potential loss of purchasing power.
Exactly. And the market is also reacting to the possibility that the Fed might not cut rates as aggressively as we thought.
Right. The Fed's actions are always a big deal for investors.
Huge.
Their decisions on interest rates can really shake things up.
For sure. So the bond market is basically saying, hold on, we might not see those rate cuts we were hoping for.
Exactly. It's all about shifting expectations and uncertainty about what the Fed will do next.
And now let's shift gears to global currencies.
Okay.
The U.S. dollar is gaining strength.
While the euro is dipping.
Right. And this all ties back to those different rate cut paths we've been talking about.
Yeah, central banks around the world are on different trajectories.
And the U.S. dollar is seen as a safe haven,
Especially during times of global uncertainty.
which contributes to its strength.
And the U.S. economy is also performing relatively well compared to some others.
So that's helping the dollar too.
Exactly.
Now moving on to energy, oil prices settled a bit lower,
And we're in the middle of thin holiday trading.
which always makes things a little more volatile,
For sure. But there are some underlying factors at play too.
like that potential supply surplus,
Right. And the stronger U.S. dollar is playing a role as well,
because it makes oil more expensive for buyers using other currencies.
which can definitely impact demand.
And finally, gold is losing its shine a bit
It is. Prices have edged lower.
because of that stronger dollar we talked about.
Yeah. And the rising U.S. Treasury yields.
They're putting downward pressure on gold.
When the dollar gets stronger, gold gets more expensive for buyers using other currencies.
Right, and those rising treasury yields make bonds more appealing.
Compared to gold, which doesn't offer any yield.
So it's all connected.
It is. Understanding these connections is crucial for investors trying to navigate these markets.
Absolutely.
So we're seeing a bit of a tug-of-war in the markets right now.
Between.
Optimism from the tech sector and some anxiety over the economic uncertainties.
Yeah, for sure. So how sustainable is this upward trend in tech stocks?
That's a tough one to answer definitively.
I figured.
The sustainability of any market trend depends on a lot of things.
Like what specifically?
Well, in this case, we're looking at things like corporate earnings, future guidance from the companies, and the broader economic conditions.
Right, so we'll have to pay close attention to those earnings reports
Absolutely. Investors will be watching those very closely.
and listening to what those company executives have to say about the future.
Exactly. If we see positive earnings surprises or optimistic guidance,
That could lead to even more gains.
it could. But if earnings disappoint or if companies start expressing doubts,
That that could trigger a pullback.
Absolutely. And we have to remember that weakening consumer confidence we talked about earlier.
Right? That adds a whole other layer of complexity,
It does. If consumers aren't feeling confident, they're less likely to spend.
which can impact those corporate profits.
Exactly. Consumer spending is a huge engine for economic growth.
So a sustained decline in consumer confidence,
Could have a ripple effect across the board. Businesses might see reduced demand, lower sales.
which could then impact hiring and investment decisions.
Exactly. It's all connected.
And then there's that data on durable goods orders.
Right, where we're seeing mixed signals.
Yeah, the increase in capital goods orders is encouraging.
It is. It suggests businesses are still investing for growth.
But the overall decline does raise some questions.
It does. The composition of those durable goods orders is important.
What do you mean by that?
Well, the strength in capital goods is positive, but the weakness in other categories.
Like consumer durables and transportation equipment.
Exactly. That raises questions about the overall health of the economy.
So it's crucial for investors to really dig into the data.
Absolutely. They need to understand the trends driving those numbers.
Now, the bond market's reaction is also interesting.
What are you seeing there?
That surge in the 10-year Treasury yield.
Right. That indicates some growing concern among investors.
What are they concerned about?
Well, rising Treasury yields can signal a couple of things.
Like what?
One possibility is that investors are anticipating higher inflation down the line.
Makes sense. If inflation expectations are rising.
Investors demand higher yields to make up for the potential erosion of purchasing power.
Right. Or they could be losing confidence in the Fed's ability to keep rates low.
That's another possibility. If the market believes the Fed might raise rates sooner than expected.
That can push those bond yields higher.
Exactly. The bond market is essentially pricing in the potential for a shift in monetary policy.
So it's a bit of a guessing game at this point.
In a way, yes, bond yields reflect expectations about future interest rates and inflation.
And all eyes are on the Fed to see what they do next.
Absolutely. Their next moves will be scrutinized.
Now let's talk about those global currency movements.
Oh, okay. What are you thinking?
The US dollar strengthening while the euro weakens.
That reflects the different expectations we're seeing around monetary policy.
From different central banks.
Exactly. And remember, currency movements can have a big impact on things like international trade and investment flows.
And even corporate earnings.
Absolutely. Companies with a lot of international exposure.
They could face some real challenges navigating these currency fluctuations.
Yeah, a stronger U.S. dollar makes U.S. goods more expensive for overseas buyers.
Which can hurt exports.
Right. And a weaker euro makes European goods more attractive to those using other currencies.
Which can boost their exports.
Exactly. These currency fluctuations create both opportunities and challenges.
And now oil prices have declined, partly due to concerns about that potential supply surplus.
Right, and that's strengthening U.S. dollar.
So how do you see these factors playing out in the coming months?
It's tough to say. The oil market is influenced by a lot of different things.
Supply and demand, of course.
Right, but also geopolitical events, global economic conditions.
It's a complex equation.
It is. If supply keeps outpacing demand,
That could put further downward pressure on prices.
it could. And that strong U.S. dollar makes oil more expensive for buyers using other currencies.
Which can dampen demand.
Exactly. And then we have to consider those geopolitical events.
Which can introduce a lot of volatility.
Absolutely. Any disruption to supply chains or political instability in oil-producing regions.
That can send prices soaring.
Exactly.
Now, gold, which is often seen as a safe haven asset.
Is losing some of its appeal.
What's driving that trend?
Mainly the stronger U.S. dollar and those rising U.S. Treasury yields.
They're making gold less attractive.
When the dollar strengthens, gold gets more expensive for people using other currencies.
And that can reduce demand.
Exactly. And those rising bond yields make bonds a better investment than gold.
Which doesn't offer a yield.
Right. People often turn to gold when things are uncertain.
During economic or geopolitical turmoil.
Exactly. But when the economy seems strong and bond yields are rising,
gold becomes less appealing. So right now we have this mix of optimism and uncertainty.
a lot of mixed signal.
And investors are on edge, waiting to see what the Fed does.
It's definitely a time for careful analysis.
And a long-term investment horizon.
Absolutely. Investors need to be discerning and adaptable.
Stay informed and be prepared to adjust.
Exactly. That's the key to navigating these complex markets.
So we're heading into the holiday season.
Yeah, we are.
How do you think that will impact things?
Well, the holiday season usually means less trading activity.
Right. Everyone's taking some time off.
Exactly.
Yeah.
Which leads to thinner trading volumes.
Which can then lead to
more volatility,
Yeah.
even if there's no big news.
So we could see some bigger price swings just because of that.
It's definitely possible. And we also have year-end portfolio adjustments to consider.
And tax considerations too.
Exactly. So it's a unique time of year for the the markets.
Looking ahead to 2025, what are your predictions?
For the global economy and financial markets.
Yeah, what's on your radar?
Well, the outlook for 2025 is pretty uncertain. We have a lot of factors that could shape things.
Like what?
Inflation, geopolitical tensions, central bank policies.
It's a lot to keep track of.
It is, and I think volatility is likely to stick around.
As investors try to make sense of it all.
Exactly. Now, inflation is still a big concern.
For sure. Do you think it will continue to moderate?
It's hard to say for certain.
Or could we see a resurgence in those price pressures?
It's possible central banks are trying to get inflation under control.
But those supply chain disruptions
And geopolitical events, strong consumer demand.
all those things could contribute to continued inflationary pressure.
Exactly. It's a delicate balance.
And speaking of geopolitical risks,
Those are definitely top of mind.
how might those impact the markets in 2025?
Well, geopolitical events always introduce uncertainty.
And volatility.
Exactly. The conflict in Ukraine, the tensions between the U.S. and China,
Other hotspots around the world.
they all have the potential to disrupt trade flows,
Impact energy prices.
weigh on investor sentiment.
It's a lot to consider.
It is. Now, the Fed's actions will continue to be a major focus.
For sure. What do you expect from them in 2025?
Well, they've said they're committed to bringing inflation down.
To that target level.
Exactly. So they're likely to continue raising interest rates.
But the pace and magnitude of those hikes.
Will depend on the economic data.
So investors will be watching those reports very closely.
Absolutely. Inflation data, employment numbers.
Any clues about the Fed's next move?
Exactly. Those decisions have a huge impact on the economy.
And the financial markets.
For sure.
Well, we've covered a lot of ground today.
We have.
From global stocks to consumer confidence to bond yields, currencies, commodities.
It's a complex and ever-changing landscape.
It is. Staying informed is key.
Absolutely. And being able to adapt to new information.
That's how we navigate these markets.
Exactly. Well, it's been great discussing this with you.
It has. Thank you for joining us.
It's been a pleasure.
And to all of our listeners out there, we wish you all the best in the new year.
Goodbye.